So with a massive 74% year-to-date surge, and analysts basically across the board screaming strong buy, is Marvell Technology ticker symbol MRVL a golden ticket fueled by the AI revolution? Or is it, a brilliantly disguised value trap ready to catch unsuspecting retail traders?
Yeah, I mean, that is the billion-dollar question right now.
Right. Welcome to the deep dive, everyone. Today we've got this huge stack of real-time financial data, technical charts, analyst reports, all from April 21st, 2026. And our mission is really to unpack the actual mechanics behind Marvell's massive breakout.
And just to set the stage here, the stakes are incredibly high with this one.
Yeah.
Because you have data pulling in two very, very different directions.
Totally. And just to be clear up front, we are debating the bull and bear cases based strictly on the data in front of us. This is an educational exploration, absolutely not financial advice.
Right, exactly.
Yeah.
We're just looking at the mechanics of the market.
Okay, let's unpack this. Because the sheer scale of where the stock is right now is, well, the velocity of this move is historic. Before we talk about the future, we have to look at the staggering market reality today.
Yeah, the numbers are wild.
Right. So closing out April 20th, the real-time price is sitting at $147.84. The trend is strongly bullish, up 5.83% just in a single daily session, and up around 74% year-to-date.
Which is a huge run for a mega cap company.
It is. But the metric that really forces you to take a step back is the 52-week gap. So the low was $48.09, and the high is $149.58.
Wow. Yes, scaling a company's market capitalization by that magnitude in just 12 months, I mean, it requires more than just a good narrative.
Exactly.
It requires hard, undeniable revenue acceleration. And that is exactly what we see in their fiscal year 2026 income statement. They posted a record annual revenue of $8.195 billion.
Which is a 42% year-over-year jump.
Right. A massive 42% jump. GAAP net income came in at $2.670 billion, which translates to $3.07 per share, and operating income is sitting at $1.323 billion.
Okay, I really want to pause on that 42% revenue jump because, growing revenue by 42% at an $8 billion scale, it's like a marathon runner suddenly sprinting the last 5 miles, right?
Yeah. That's a great analogy. It's incredibly hard to do.
Because it's not like a software company where scaling just means spinning up more AWS servers. Marvell is dealing with physical silicon.
Exactly, physical hardware.
Right. They have to secure fab capacity at places like TSMC, manage these massive global supply chains, deal with physical yields. So a 42% leap in hardware revenue means their execution has been practically flawless in an environment where components are, famously scarce.
That physical constraint is such a crucial point to keep in mind. And it really explains the structure of their balance sheet, too. We're looking at total assets of $22.285 billion against $14.308 billion in equity.
But then there's the debt, right?
Yeah, the number that often gives investors pause here is the $3.971 billion in long-term debt.
So I actually want to push back on that a little bit. Is nearly $4 billion in debt really an immediate red flag here? Because when I look at their cash flow statement, they generated a net cash flow of $1.7 billion for the year.
Right, the cash flow is super healthy.
Right, and in the capital-intensive world of semiconductor design, taking on debt to finance expansion or make strategic acquisitions, that's standard operating procedure. So with $1.7 billion in free cash flow, doesn't that make the debt practically a non-issue, a managed lever rather than a survival anchor?
Well, I mean, you're right that the balance sheet shows really solid footing. The leverage is entirely manageable as long as the revenue engine maintains its current RPM.
Ah, okay, as long as growth doesn't stall.
Exactly. A company takes on that level of debt because they model a return on capital that far exceeds the interest expense, and the $1.7 billion in cash flow proves they're generating those returns right now. But debt only becomes an issue if growth stalls.
Which perfectly sets up the next question. Where is this explosive growth actually coming from?
Right. We have to look at the catalysts.
So reading through the sources, the primary bull case points universally to robust AI demand and accelerating growth in the data center segment. But the real standout is the strategic partnership narrative, specifically the potential co-development of a custom AI chip with Google.
What's fascinating here is how these aren't just incremental updates, right? These are foundational shifts for Marvell. The shift toward custom ASICs, application-specific integrated circuits, it's fundamentally changing the semiconductor landscape.
Because for years, hyperscalers like Google and Microsoft just bought off-the-shelf GPUs, right?
Exactly. They relied heavily on general-purpose GPUs from companies like NVIDIA to train their models. But as AI models scale into the trillions of parameters, running general-purpose GPUs becomes incredibly inefficient.
They just consume way too much power.
Too much power, too much heat, especially for very specific repetitive workloads like search or targeted large language model inference. So Google realizes they need proprietary silicon optimized specifically for their internal architecture to cut down those massive electricity costs.
But Google is a software giant. They don't have like decades of low-level semiconductor physics expertise.
Right, so they partner with Marvell. And securing a hyperscaler like Google changes Marvell's revenue trajectory entirely, creates this near impenetrable competitive moat.
How so?
Well, if you sell an off-the-shelf component, your customer can swap you out for a cheaper competitor next quarter. But if you co-develop the fundamental architecture of their custom silicon, you're deeply embedded in their physical infrastructure. The switching costs for Google to move away would be astronomical.
Wow, so it locks in a recurring high-margin revenue stream for years.
Exactly.
And that deep integration, I mean, it makes perfect sense of their recent acquisition of Celestial AI, too.
Oh, absolutely. Celestial is a huge piece of this puzzle.
Because they're right at the bleeding edge of silicon photonics. And for anyone tracking data centers right now, the bottleneck isn't computing power anymore. It's data transfer. You have tens of thousands of processors trying to talk to each other. And traditional copper wiring literally cannot handle the bandwidth without overheating.
Right, or creating massive latency. So silicon photonics solves that by moving data, using light, using photons instead of electrons. It reduces power consumption drastically while multiplying bandwidth.
It's brilliant.
It is. By acquiring Celestial AI, Marvell is attempting to own the fundamental plumbing of the next generation AI data center.
So the fundamental story is incredibly strong, but I have to ask a grounding question here. Are we buying the rumor or the news at this point?
That is the perfect question to ask because it leads us directly into how traders are reacting on the charts right now. We have to transition from the why to the how of the stock's daily movements.
Exactly, because when we look at the technical analysis and the actual trading battlefield, the picture gets tense. I mean, we're looking at a stock priced at $147.84, but the 50-day moving average is way down at $95.52.
Yeah, that is a massive gap.
And the 200-day moving average is at $84.48.
The sheer velocity of this breakout is wild. When a stock is trading more than $50 above its 50-day average, you're looking at unprecedented momentum.
And we can quantify that momentum. The MCD, the moving average convergence divergence, is sitting at 4.09, which is a textbook buy signal. But here's where it gets really interesting. The RSI, the 14-day relative strength index, is at 74.53.
Yeah, that is a glaring warning sign.
Right. I mean, an RSI over 70 is like a car engine running in the red zone. It's moving incredibly fast, but it's totally overbought, and it might need a short-term cool down before it blows a gasket.
Exactly. And that highlights the tension between the indicators here. The MCD is signaling continued fundamental momentum, right? It's telling you the horsepower is there. But the RSI is suggesting severe short-term weakness, or the high probability of a pullback.
The buying pool is just exhausted.
Yeah, the structural stress on the buyers is immense. You just have to look at that gap between the 147 current price and the $95 50-day average.
And you can see that stress playing out in the order flow. The battle lines are so clearly drawn. Buyers are heavily concentrated at the $143 support level.
Right, that's the psychological floor.
But the moment it pushes toward the $149.50 intraday high, massive selling pressure hits. We're seeing immediate resistance at 148.62 for R1 and 149.1 for R2, with support below at 148.24 and 147.75.
It's incredibly tight. It's basically algorithmic hand-to-hand combat at these levels.
It really is. The buyers at 143 believe the Google AI narrative justifies pushing past 150, but sellers near 149 see that 74 RSI and decide to lock in profits.
And this brings us to a glaring contradiction of the sources. The technicals and analysts say buy, but other metrics are flashing serious warning signs.
Right, let's pivot to the bear case here. Is this an undervalued gem or a retail value trap? Because institutional consensus is overwhelmingly a strong buy across 32 to 37 different analysts.
Right. Oppenheimer just raised their target to 170. GF Securities bumped theirs to 165.
But when you look at the quantitative models, it's a different story. The models in our sources show Marvell is significantly overvalued, trading at a 47% premium versus its intrinsic value.
A 47% premium. That leaves zero margin for error.
Zero. The PE ratio is sitting at 44.08x against a fair ratio of 40.86x. But here's the part where I have to act as the skeptical listener. If Oppenheimer is saying this goes to 170, why is the insider selling so heavy?
The insider data.
Yeah, the data shows $24.9 million sold by insiders in just the last 3 months. And crucially, the CFO dumped 30,000 shares right on April 15. If the stock has a straight shot to 170, why is the CFO taking that much risk off the table right now? Is this where retail traders get trapped buying at the absolute top while the insiders cash out?
If we connect this to the bigger picture, it's a very nuanced situation. Executive selling can be entirely routine. They use pre-scheduled 10b5-1 plans for tax purposes or plan diversification.
So they get paid in stock, they have to sell eventually.
Right. But combined with a 47% overvaluation and an overbought RSI, it introduces significant downside risk and volatility. Your concern about the retail trap is completely valid.
Because it happens in every tech cycle.
It does. Retail buys in on FOMO, the fear of missing out right after a massive headline drops. They see the 170 target, they buy at 148, which provides the exact liquidity that institutional money needs to quietly exit their positions.
And because the retail trader isn't looking at the 74 RSI, they buy the exact top. And then the technical correction hits, the stock drops back toward that $95 moving average, and retail is trapped holding the bag.
Exactly. And there's another huge downside risk embedded in the fundamentals. Hyperscaler reliance.
Right, the customer concentration issue.
It's a major vulnerability. The entire bull thesis relies on a handful of mega clients. If a massive customer like Google changes their mind, or if a macro shock forces them to slash data center capital expenditures, Marvell's projections collapse.
It's a binary risk.
Yeah, relying on a few giants is great on the way up, but it's disastrous if demand falters.
So bringing this all together, transitioning from the immediate risks to the ultimate outlook, what does the short-term versus long-term look like?
Well, the short-term outlook is undeniably bullish in trend, but highly, highly volatile because it's so overbought. We're going to see violent intraday swings.
A sharp drop to cool off that RSI seems highly probable.
It does. But the medium to long term is anchored by these massive revenue targets. $11 million for fiscal year 27 and $15 billion for fiscal year 28.
So the best case recovery scenario, the bull case, is that the technicals cool off without breaking support. The Google chip launch goes flawlessly, they integrate Celestial AI, and they hit that $15 billion target, pushing the stock well past 170.
Exactly. And the worst case bear scenario is a continuation lower. The RSI cools off aggressively, triggering institutional selling. The price drops closer to those moving averages in the 90s, and simultaneously, hyperscaler demand falters,
leaving them with $4 billion in debt and a bloated multiple. So what does this all mean for you listening? It means Marvell is a fundamental powerhouse, absolutely, but it's currently trading at a premium that demands serious caution.
This raises an important question for everyone listening. What stands out to you? I mean, is the 42% revenue growth enough to ignore the high PE ratio and the overbought technicals?
That is the tightrope you have to walk with this stock right now. Thank you so much for joining us on this deep dive into Marvell. We are going to leave you with one final provocative thought based on the sources.
Let's hear it.
If Marvell's entire future and that $15 billion target is so heavily tied to co-developing chips with a giant like Google, what happens to this $147 stock price if Google suddenly decides they've learned enough and they build those chips entirely in-house? Ponder that massive risk. We'll see you next time.